Hello everyone, welcome to our International Cargo Transportation Insurance course. In international trade, there is usually a long distance between the importer and the exporter, and no matter which mode of transportation they've chosen, various kinds of risks and perils may happen and cause certain kinds of loss or damage to the goods at each stage of their long journey. For example, cargoes in transit may be damaged due to the breakage of packing, tsunami, fire, and so on. In order to minimize the financial losses, importers or exporters usually change the uncertain risks into fixed charges by purchasing insurance. If any unfortunate incidents within the carriage of the insurance occurred, the insured would be compensated with certain amount of money. With the development of society and the improvement of people's living standards, insurance has gradually become an indispensable part of people's lives. There are many kinds of insurance, such as life insurance, car insurance, medical insurance, unemployment insurance, and so on. Why do we need to buy insurance? The most direct purpose of buying insurance is to avoid risks. At various stages of life, one may face various risks such as accidental injury, illness, property damage, and more. By purchasing corresponding insurance products, one can obtain certain economic compensation when risks occur, reducing the economic losses and the life pressure caused by risks. Generally speaking, insurance refers to the commercial behavior in which the policyholder pays the insurance premium to the insurer according to the contract agreement, and the insurer assumes responsibility of compensation for the property losses caused by the possible accidents that may occur as stipulated in the contract, or assumes the responsibility of paying insurance benefits when the insured dies, becomes disabled, suffers from illness, or reaches the age, term, and other conditions stipulated in the contract. From a legal perspective, insurance is a contractual act, and the economic relationship between insurance is established through the signing of an insurance contract between the two parties. According to the provisions of the insurance contract, the policyholder is obligated to pay the insurance premium, and the insurer shall fulfill the obligation of insurance compensation or payment in the event of an insurance accident. From an economic perspective, insurance is an economic compensation system and a financial arrangement for sharing losses caused by accidents. The people facing homogeneous risks, that is, the vast number of insured persons, are organized through insurance companies. Insurance companies centrally analyze and manage risk loss data, use statistical methods to predict the losses caused by risks, and establish an insurance fund using the insurance premiums paid by all risk transfers to centrally bear the economic losses caused by the insured due to risk accidents. In this way, through the insurance system, the personal risks of the insured can be transferred and dispersed. The insurance industry provides precise protection for people's life safety and health. Every member who participates in the insurance system will receive insurance assistance in the event of an accident. Insurance belongs to a mutual aid group organized by social freedom and requires a group of people to reveal its importance to people and persuade them to participate in insurance, because only by organizing as many people as possible to participate in mutual aid can insurance demonstrate its enormous protection ability. Specifically, Insurance has the following basic functions. First, transferring risk. Buying insurance means transferring one's own risk, and the institution that accepts the risk is the insurance company. Insurance companies accept risk transfer because insurable risks still have patterns to follow. By studying the contingency of risks to find their inevitability, mastering the laws of risk occurrence and development, insurance protection is provided for many people who have concerns about danger. Second, sharing loss. Transferring risk is not about the disaster actually leaving the policyholder, but about the insurer using everyone's financial resources to compensate for the economic losses suffered by the policyholder and solve their problems. The insurer distributes the huge losses of a few individuals to a large number of insured persons in the form of collecting insurance premiums and paying compensation, thereby making losses that are difficult for individuals to bear losses that can be borne by the majority. This is actually sharing the losses equally among policyholders with the same risk. So, insurance only has the function of sharing losses, but not reducing losses. Third, implementing compensation. Sharing losses is the prerequisite and means of implementing compensation, and implementing compensation is the purpose of sharing losses. The scope of compensation mainly includes the following aspects. 1. The property losses suffered by the policyholder due to disasters and accidents. 2. The insurance benefits that the policyholder should pay upon the expiration of the insurance period due to personal injury or death caused by a disaster or accident. 3. The economic compensation payable by the policyholder to others in accordance with the law due to disasters and accidents. 4. The economic losses suffered by the policyholder due to the other party's failure to perform the contract. The derivative functions of insurance include risk management, investment management, and social management. Risk management is one of the core functions of insurance, which involves collecting premiums to establish a risk pool, dispersing and transferring risks, protecting customers' financial security, and maintaining social stability. Investment management is crucial for insurance companies to manage their funds, requiring them to seek and select suitable investment opportunities globally, balance risk and return, and pursue long-term and short-term goals. Through effective investment management, insurance companies improve financial stability and provide better returns to customers. The social management function of insurance mainly refers to the objective role that the insurance companies play in providing necessary guarantees for social protection and people's lives in the process of providing commercial insurance products, thereby relieving the worries of social producers and having a positive effect on the entire society.